Happy Friday, everyone. Thanks for joining us on this edition of Business Daily. Coming to you live from Seoul, I'm Mi Ji-yoon. Before we get started, let's first get a quick check on today's highlights. With many lingering economic uncertainties this year, one expert says a new strategy is a must for Korea's struggling exporters to get back on its feet. From wild swings in China's financial markets to hot tech innovations at CES, we dig deeper into global business stories that made headlines this week. But first, Samsung Electronics says its fourth quarter earnings likely fell below analysts' expectations. The firm's operating profit jumped on year but slid on quarter, which watchers say was probably due to sluggish demand for its smartphones and components. Our Kim Min-ji starts us off.
Korea's tech giant Samsung Electronics' fourth quarter earnings missed market expectations. According to the company's earnings guidance, operating profit stood at just over $5 billion during the October to December period, up more than 15% on year, but down over 17% from a quarter earlier. Sales rose 0.5% from a year ago to over $44 billion. The operating profit estimate falls below the market consensus of $5.5 billion and marks a quarterly decline for the first time in 5 quarters. Sales also missed analyst expectations of $44.5 billion. Looking at the whole year, operating profit jumped more than 5% on year to $22 billion, while sales fell almost 3% to nearly $170 billion. However, Samsung posted an annual revenue of more than 200 trillion won, or roughly $167 billion, for the fourth straight year. Analysts attribute the slowdown in earnings to weakening chip and smartphone sales, Samsung's two biggest cash cows. But some expect the company's consumer electronics arm to post improved earnings on the back of strong TV and home appliance sales due to seasonal demands. The guidance figure does not break down the performance by sector. The company's finalized earnings will be announced later this month. Kim Min-ji, Business Daily.
Hyundai cars have long been the go-to vehicles, that is, for Koreans, but stronger competition from local and foreign automakers is eating into the company's local market share. In fact, Hyundai Motors' domestic market share dipped below the 40% mark for the first time ever in 2015. According to industry data, Hyundai's share stood at 39%, down more than 2 percentage points from the previous year. The combined market share of Hyundai Motor and its affiliate Kia Motors remained below the 70% mark for the second straight year. Their domestic presence is shrinking due to growing challenges from import brands and smaller local rivals. And with that, let's now get a quick check on how the markets fared here in Seoul today. Korean shares ended higher on Thursday, rebounding from their 4-month low as China tried to ease concerns over the devaluation of the yuan. At the closing bell, the benchmark Kospi gained 0.7% to close at 1,917.62, while the tech-heavy Kosdaq also rose 0.43% to finish at 682.56. On the foreign exchange counter, the Korean currency ended at 1,198.11 against the U.S. dollar. Dubai crude, a pricing benchmark of oil exports to Asia, has nosedived to a 12-year low, reaching about $27 a barrel for delivery in March. This drop under the $30 range comes in less than 2 months since its previous plunge in November, when it spiraled below $40 a barrel. Other benchmarks, Brent crude and West Texas Intermediate on Thursday, also tumbled to levels lowest in over a decade, sitting under the $35 mark. The slide came after a surprise depreciation from the People's Bank of China and an ensuing second circuit breaker on stock markets this week, spurring concerns that the world's second largest economy is doing worse than expected. Now, despite hopes that economic conditions will improve this year, many of the uncertainties that dragged down Korea's growth in 2015 are looking to stay for the time being. And our Hwang Ji-hye sat down with the president of the Korea Institute for International Economic Policy to talk about what the next 12 months might hold.
So the Korean government focused a lot on boosting domestic demand last year, and that was because of the slowing exports. But conditions aren't looking so bright this year either. So what's your take on the export outlook this year?
Export most likely will not decline. Last year, what happened was our export declined because of the oil price decline. Obviously, there have also been other factors like the slowdown in EMs, as well as in advanced economies. This year, most likely, the drop itself will not take place because it's already at the bottom. So as they bottom out, the growth rate itself will not fall, but it will not actually recover to where it was last year. So looking at our market or our export overall, we are actually running out of time. Our traditional export strategy has run its course. It has served us well, but we are now entering a new global environment and we need to come up with a new revised strategy for our exports.
Because the growth in the second half was mainly driven by the government, people are now concerning about a drastic drop in spending early this year. Do you also agree with that notion?
No. I don't think that we will see a sharp drop in consumption because consumption is something that is dependent on our livelihood. Whether we can maintain the 2% in terms of consumption growth, that's a question that we have to ask seriously about.
Then where do you think Korea should focus most on?
Value creation. Value creation, and because it's actually a very highly charged word, because of technology, globalization, and you name it, these various combinations have actually led to a situation where the global economy can produce things for everyone with much less people. And that essentially means lower wage share. Lower wage share means less income. Less income means less consumption, and thus less investment needs. And thus we have actually entered a vicious cycle where the economy doesn't work anymore. So essentially we have capital and labor. We need to optimally allocate those. And because we are running out of labor locally in 10, 20 years, we need to diversify our capital outside.
But won't that create asset outside of the country, not inside of the country, since like factories or other value creation is taking place outside of Korea?
That's why at the same time we have to ensure that our business environment is friendly so that foreign capital can actually come into Korea wherever there is a competitive advantage. At the moment, that's not taking place. We need to level the playing field between large and small, between foreign and domestic companies. We need to make the labor market more flexible. It has to have much easier solution in terms of the processes in dealing with labor problems, because many companies, foreign companies, are staying out because of this issue.
So creating a business-friendly environment is, I guess, crucial. Thank you so much for your time today.
Thank you.
It's Friday, and that means it's time to look back through some global business headlines this week. And for that, we're now joined by our Eunice Kim in the studio. Hello, Eunice.
Hello, June.
All right, so we're finally nearing the end of this year's first full business week.
And what a week it has been, right?
I mean, off the top, the China market rout really dragged down world markets. I mean, prompting fright of trillions of dollars from equities worldwide. And now authorities have pulled the circuit breaker mechanism itself, at least for now.
You're absolutely right. And that move did come late yesterday after that second market, when markets were shut down for the second time this week, 29 minutes into the trading day, which is the shortest in a quarter century. Now, and the move seems to have calmed the jitters we saw earlier this week. The Shanghai Composite did end the volatile trading day in the green, up nearly 2%, lending credence to to this late decision by China's securities regulator. Now, there were concerns the circuit breaker mechanism itself might have worsened the stock sell-off as panicked individual investors, of which there are many in China's markets, saw it as a sign to offload before the doors are shuttered, so to speak.
But circuit breakers themselves are not really a foreign concept. I mean, they're used to calm sudden sell-off, and there's some things that we saw here in Korea as well as in the U.S., right?
We have circuit breakers here in Korean markets as well as U.S. markets, and that's why there are voices saying this was applied wrongly. The circuit breaker was, of course, only introduced Monday of this week and this year. The circuit breaker on Shanghai and Shenzhen triggers a 15-minute pause in trade when the CSI 300 index falls 5% from the previous day's close, and trade is suspended altogether if that hits 7%. Now, that's how it works, but experts say that's awfully low for China's stock exchanges, where trade has been, of course, volatile compared to, say, the New York Stock Exchange, where it takes a 20% fall on the S&P 500 to shut down trade for the rest of the day.
But then this doesn't really ease concerns surrounding China's slowed growth. Can you tell us more about some data that came out this week?
Absolutely. The latest is a report on China's foreign exchange reserves, which did register the biggest monthly and annual drop in December and in 2015. The People's Bank of China said Thursday its reserves saw a near $108 billion drop just last month, which means it fell every single month in 2015 except for May. China's reserves lost $512 billion throughout the year to $3.3 trillion, which was worse than what forecasters had expected. This as the world's second largest economy spends massive amounts of U.S. dollars to prop up its currency on the global stage.
Oh, definitely. We'll have to look at this next week as well, how the stock markets are going to react.
We'll keep our eyes on it for sure.
All right. Well, next we're off to Las Vegas, where the world's biggest technology show is underway. And I heard that response this year has been quite phenomenal.
Absolutely. Tens of thousands of products were on display as future technologies took the spotlight this year, while tech heavyweights like Samsung and LG were certainly present. So were social media companies, hundreds of startups, and car companies. We take you there.
At the Consumer Electronics Show this year, some 200,000 professionals flocked in for a first-hand look at the cutting-edge technology on offer. No, this isn't the Detroit Auto Show, but front and center were cars, as they become more and more electronic.
We disappointed our customers and the American people, for which I'm truly sorry, and for which I apologize.
With hopes of turning over a new leaf, Volkswagen's brand chief used his keynote to unveil the German carmaker's electric concept car. Within its modern classic exterior, the Buddy features a linked information hub dashboard and plenty of space thanks to its electric toolkit system. Where Tesla currently reigns supreme, China money-backed startup Faraday Future showed off its sleek electric concept race car, as GM presented its all-electric compact, the Bolt, that the U.S. carmaker hopes will push EVs into the mainstream with its $30,000 range sticker price. And there was plenty for those who are not in the market for a new ride. Conference goers met Relay, a delivery robot that independently moves through a skyscraper. Watched UAVs in action in a zone dubbed the Drone Rodeo, and saw their face in gaming characters thanks to 3D infrared technology. There was news dropped at CES too. Recently acquired by Facebook, Oculus revealed virtual reality enthusiasts would be able to pick up their own Rift headset, priced at a cool $600 and more for the system. Streaming media company Netflix used the event to announce it was expanding business to over 130 countries on Thursday, including Korea. Its co-founder and CEO Reed Hastings calling it the birth of a new global internet TV network.
Wow, a lot of cool stuff there.
Absolutely.
All right, well, but I think it's interesting that of the 7 keynote speakers at CES, 2 of them were actually from major auto companies,
That's
Volkswagen and General Motors. Now, are we going to see a surge in electric cars being rolled out?
Well, isn't it ironic in this era of low oil prices that
Right.
we're seeing really nearing $30 a barrel, that we're seeing this boom in EVs. But apart from global commodity currents, electric vehicles have been in the pipeline amid a general worldwide consensus that dependence on fossil fuels must be eased. Automakers, too, are expressing enthusiasm it will be a growing market as technology improves and demand grows. But there is regulatory pressure too. For example, the U.S. state of California, home to some of the strictest environmental standards when it comes to cars, will require that all automakers ensure at least 10% of their sales constitute zero-emission vehicles. Now, I thought this was interesting. That's either EVs or fuel cell-driven cars, and this rule will come into effect in 2020, now less than 5 years away. So automakers are getting a move on. Otherwise, they'll face a $5,000 fine per car in their sales target. And since California is the largest U.S. auto market, this is something that automakers simply cannot ignore, June.
Well, let's hope to see more of these eco-friendly cars here in Korea as well.
Yes, absolutely.
Thank you so much for coming in today, Eunice.
You bet.
And that wraps it up for today and this week. But we'll be back next week with more business news that matters to you. So don't forget to tune in then. Thanks for watching and have a great weekend.